Hey, good morning, everyone. Marty Missouri here. It is the 28th of February, 2026, with your weekly update. So, of course, the news of the weekend is what's going on in the Middle East. You don't need me to really talk about those details. And, of course, those are going to be coming and changing in fast and furious fashion over the next few hours and days, no doubt. But I do want to talk about the market reaction, or what we should expect the market reaction to be. But first, let's just run through some of the data points that are included in our PWA index. There's 43 in total. I just scored it. It is a positive 9, and I'll just pull that chart over here real quick. So this is just our simple chart of the index. So you can see we are in positive territory. We came into it, tested the zero level, and that, the way we read it, says that odds favor continued expansion over recession in the foreseeable future. Of course, all subject to change. Again, the news of the weekend, if that were to become something lasting and would have a lasting impact on oil prices, that could be quite the drag on the economy. So what you have in front of you, and I'll just go through the charts as I have them lined up. This one is U.S. mortgage purchase applications. As you can see, as of last week, we have broken this uptrend line right here. So that moved down a notch in our scoring. Consumer confidence actually picked up just a tick here this last week in the Conference Board's reading. You can see we have a higher low there, although these are historically, pretty low levels of optimism, if you will, or sentiment for the consumer. Exceedingly low when we look at the University of Michigan survey. So again, we're looking for improvement there. We'll see as folks begin receiving these big tax refunds that they're supposed to get here shortly. The Chicago Fed National Activity Index, it's kind of an economic index within our index, actually improved to 0.18 for the month of January, with 57 of its 85 indicators improving over December, and overall 47 reading positive, 38 reading negative, and that moved from a negative score to a neutral score in our index. The Economic Surprise Index, this is how the data are coming out relative to economists' published expectations. And you can see the U.S. Economic Surprise Index is solidly above the zero line, which means that the data have been coming in better than what economists had expected. Now, this is the only one that we actually score in our index, but we do pay close attention to other areas as well. Here is the Eurozone. You can see it's still somewhat comfortably above zero, although moving down here a little bit recently. Japan has been falling, again, meaning the data relative to what economists had anticipated for Japan has been waning of late. China has been improving, still slightly negative, but just slightly. So again, improvement relative to where it's been of late. The emerging market complex, very positive data relative to expectations. So this would capture, of course, Latin America, which has continued to be quite the place to invest so far this year. And then the Global Economic Surprise Index, down a little bit of late, but still solidly above the zero line. So in the aggregate, nothing right here that would scream high recession risk. The Producer Price Index for January came out on Friday. Written blog, I featured at least one headline that suggested that the market sell-off had to do with this. However, I would say unequivocally that wasn't the case. The sell-off had to do with the obviously correct assumption that a strike on Iran was forthcoming because of the way other markets like gold and bonds reacted. If you didn't read that, it's very brief. You might want to take that one in. But the Producer Price Index, you can see that the headline index actually dropped a little bit to 2.9% year over year. However, the core, when you X out food and energy, saw quite the jump to 3.6%. And the monthly move in the headline index, 0.5%. So that is heating up relative to the previous month and relative to expectations. However, CPI swap rates or inflation break-evens, you can see actually went down on Friday. So this suggested that market-based compensation for inflation, some say expectations, actually went down on Friday, even though we had the hot PPI number. And this would be concern, obviously, over the geopolitical setup, I would suggest. Commodities, on the other hand, the Bloomberg Commodity Index has continued to rise near record levels. The raw industrials, the CRB Raw Industrials Index, also is at very, very high levels, historically speaking. And of course, there's the price of copper rising as well. So we have a pretty much across the board rise in commodity prices, while interesting market-based measures are actually discounting perhaps falling inflation. But you might argue that commodities are beginning to price up, headwinds to production due to geopolitical risks, if you will. But remember, there is a massive amount of infrastructure build-out going on in AI. We anticipate that in the energy space. We know that the grid needs a lot of work as well. And then just general infrastructure spending in the U.S. via the One Big Beautiful Bill Act and so forth. You would expect commodities to respond to those demand pressures as well. So legitimately, there are more than one explanation for why commodities are rising, and arguably probably a combination of those. Okay, so let's talk about the credit market for a minute, because in our world, we're seeing lots and lots of interest in private credit, the loans and the companies that provide that credit. So the leverage loan index is important to watch, and it could be a signal of financial stress. And you can see it has been taking, a pretty notable hit of late. The stock of business development companies, the companies that provide the funding for business startups and companies that need cash and so on, it has been really getting hammered right here. We're hearing about a rise in defaults, particularly in places like the healthcare sector and so on. So this is a warning sign about the state of credit markets, in this case, the private credit market, which is bigger than it's ever been. While at the same time, when we look at credit spreads that we score for our financial stress index, while, for example, the high yield spreads, this is essentially the spread on high yield bonds relative to treasuries, you can see is up 2.77%. Historically, though, that's a very low spread. So directionally, it would be the beginning, maybe a yellow flag, but the level itself is very, very benign. Now, as you can see here, we do need to take these bounces off the bottom seriously, because they do often tend to morph into something that is a serious red flag at a time when markets, the equity market, for example, tends to feel its own stress. So 2022, while this was happening, we saw a 30% peak to trough decline in the S&P 500. We know about COVID, right? We had a pretty good 16% correction in equities right in here. We had the European debt crisis. We had a 20% hit right in here. Of course, the Great Recession, and so on. So again, the fixed income markets are essential to gauge the overall, health of the credit system in the U.S. in these examples. But again, level low, direction concerning. Another way to look at stress in the market is the price of credit default swaps. So they are essentially contracts that insure the buyer against default of a given credit. This is the average price of CDS, credit default swaps, on high yield debt. And again, you can see relatively low historically, right? Not in the danger zone, but you can see what happens. Here's your 2008. Here's your COVID. Here's your 20% hit early last year on Liberation Day, right? So you can see that these are very sensitive and could be a signal for stress in the system. Right now, again, just like the high yield spread, level low, but direction concerning. We also track it for investment grade debt. Okay, so this is higher quality debt, not junk bonds, which would be your high yield. And you can see it's spiking as well. Now again, 56 is historically tame, the direction we need to pay attention to. Okay, so there'll definitely be more on that in the weeks and months to come. Right now, warning sign about stress in certain areas of the credit market currently. Okay, so quickly, the S&P 500 one-year daily chart. Folks, you can see we're living right here in this trading range, right, that I have outlined with the dotted lines. The current level of the S&P takes us back to late October of last year. So the S&P isn't doing anything, pretty flat on the year so far. This is your 50-day moving average. It's a very key technical indicator. You can see how it will be support. It has been support, but you break down and it can become resistance. You can see it broke down Friday and closed below the 50-day moving average. One day closing below does not a trend make, but if that were to break this support line right here with momentum, I don't see anything stopping it before the 200-day moving average. And then this line right in here, so there's kind of some double support right in here building. But, that's a noticeable hit, and that would get people's attention. That's several percentage points lower from where it is right now. So to get a feel for the market impact of the weekend events, I'm going to take a quick peek here off the screen. There are these trading platforms, one in particular that you can trade with other people over the weekend, and the facilitator has a methodology that determines a hypothetical price, for example, for the Dow, and then what people do is they bet on movements away from that price among each other over the weekend. So, for example, as I speak, in this weekend trading, the Dow is down 539 points. So definitely, a negative. It's not huge, by the way. It's 1.1%. But definitely, the market is concerned. And that suggests that the open, if it were to open right now, if this were a Monday morning, would be notably lower. And often I've found that when it's negative like this, it actually becomes worse in the real cash trading session on Wall Street. The NASDAQ 100 proxy is down 1.16% or 290 points, and that's not small either. We can also track, hypothetically, the price of oil. And right now, on this trading venue, the price of oil is up 11% on this news. And again, that should be expected given what's going on. Another thing that I can do over the weekend is track the price of gold in the crypto market. So there's a couple crypto-based tickers, if you will, and those have gold up 3.2% and 2% respectively. So yes, indeed, as you would expect, key markets that would respond to this news over the weekend, and by the way, the same markets that I was talking about on Friday in anticipation of this news are clearly reacting as you would expect. And then with the S&P 500, we still have these bearish divergences. Remember, we have this range in here, but with momentum waning, it does suggest that odds favor a breakout below. But of course, in this crazy volatile world we live in, the technicals can be defeated rather easily with a news headline or two. And then tracking the ETF that tracks the NASDAQ 100 index. I like the 20-day moving average for this on a short-term basis. You can see it closed below that. And the 50, the 20 is broken down below the 50, getting closer to the 200-day moving average. Tech has had a not good year so far, as we've discussed. And then momentum suggesting that there could be more downside here as well. I think I'll go ahead and skip the gold and dollar and yield charts. There's going to be so much volatility over there the next few days. I'll update you next week on how those technicals look. And folks, I guess I'll just leave it there. Thank you as always for watching and listening. Hope you have a good weekend, and I'll be back at you next week. Take care. Bye-bye.